everyone, I just wanted to do a quick video today on something that we hear a lot of here, and it's self-employed people, and they often think that there's this perpetual myth essentially that if you're self-employed, when you go to get a home loan, it's going to end up being more expensive, that a bank is going to charge you a high interest rate purely because you're self-employed. And it's funny that we hear it so often because it's just completely untrue. A bank won't ever look at you and your situation and just say, okay, because you're self-employed, all other things being equal, we're going to charge you more. It doesn't really work that way. But there is a bit more to it than just this, okay? I'll give you an example. Let's say you are a company employee and you earn $80,000 a year. The way a bank looks at that is, sweet, you get $80,000 every year. And if you get a company car or something like that, then that's paid out of the company and that's totally fine. But if you're a director of the same company, the way the debts of that company are assessed may mean that you don't have as wide a range to as many lenders as the same person who is a company employee. When a bank looks at these debts in a company, they will basically assess the company and your ability to repay a loan under the worst conditions they can imagine. They want to make sure that if everything well and truly hits the fan, that you can still make your loan repayments. And what I mean is this: let's say you're a tradie and you've got 3 or 4 company cars. You're making all those repayments, you're paying down that asset finance easily. But the way a bank looks at it is that even if you are still paying yourself $80,000, so you're still paying down all these assets and you're still managing to pay yourself $80,000, they will look at these debts over here and they will basically inflate all those debts to make sure that under the worst case scenario, you can still pay it off. So that might mean that the bank says, we're going to ignore any balloon repayments, we're going to increase the interest rate up to 7.5% even though you're only paying 4%. And we're going to shorten the term on the loans to make the repayments seem even bigger. So even though you're still paying yourself this $80,000, the way a bank assesses it means that they say, well, these debts over here are going to cost you another $30,000 or $40,000 a year. So it doesn't mean that they're increasing your interest rate. It means that they're basically saying that you're not going to have as much money left in your hand at the end of the year. So what a good broker will do for you is they will look at all the different options available to you, because there's lots of lenders who don't assess things this way. They will actually have more of a sort of common sense approach to this. And a good broker will basically help you navigate through this sort of, this minefield, and they will prioritize lenders for you who will suit your company and your situation. So to, answer this myth, no, you never will pay a high interest rate purely for being self-employed, all other things being equal. But the choice of lenders you have may be different if you are self-employed, depending on the company you have and the debts in that company. So if you do have any questions about this, or you want to see if maybe your company is suitable for a certain type of lender, or you just have any questions about this in general, you can contact me on hugh@linkadvance.com.au or 0738998311. Thanks guys.